Welcome to Boni's Life, your home for intellectual, no-nonsense analysis of the financial world. Today, we are diving deep into the turbulent waters of the crypto market. Whether you are a seasoned trader or just crypto curious, you have come to the right place. We are going to cut through the noise, dissect the data, and give you the actionable intelligence you need to navigate this market with confidence. So grab your coffee, settle in, and let us get to it. First, let us look at the tail of the tape. As of February 18th, 2026, the total cryptocurrency market capitalization is sitting at $2.39 trillion, according to CoinGecko. That is a number that would make even a Bond villain raise an eyebrow. But here is the thing, it is down 0.5% in the last 24 hours, and the 24-hour trading volume stands at $90.92 billion. Bitcoin, the undisputed king of crypto, commands a dominance of 56.2%, while Ethereum holds a respectable 9.94%. We are currently tracking 18,889 different coins across 1,467 exchanges. That $2.39 trillion is not just a vanity metric. Its 0.5% dip in 24 hours represents roughly a $12 billion reduction in value. The $90.92 billion in trading volume shows a market that is active but perhaps indecisive. High volume on a down day can suggest distribution, where larger players are selling into the hands of smaller, less informed buyers. Bitcoin's 56.2% dominance is a critical indicator. In times of fear, capital often flees from more speculative altcoins back to the relative safety of Bitcoin. A rising BTC dominance in a falling market is a classic defensive posture. Right now, the market is telling us that safety is the priority. Now, for the main event, Bitcoin is currently trading at $67,145, down a slight 0.6% in the last 24 hours. Ethereum is at $1,971, also down a touch at 0.7%. XRP sits at $1.46, down 1.3%. Solana is at $82.30, shedding 2.4%. BNB holds relatively steady at $615.67, down just 0.2%. The stablecoins, Tether and USDC, are doing what they do best, staying stable at around $1. But look at the 7-day changes, and that is where the real story unfolds. Dogecoin is down a whopping 12.5%. Cardano has shed 11.1%. XRP has lost 7.8%. Solana is down 2.4%. On the flip side, Zcash is up an impressive 24.4% over the past week. Bitcoin Cash has gained 8%, and BNB has added 3%. Privacy coins and Bitcoin forks are showing relative strength, which is an interesting signal in a market dominated by fear. It is a mixed bag, a real tug-of-war between the bulls and the bears. Now let us peel back another layer of the onion and look at the derivatives market courtesy of CoinGlass. The 24-hour derivatives volume is a massive $147.49 billion, up nearly 6% from the previous day, and the total open interest across all exchanges is $94.80 billion. But here is the kicker. The 24-hour liquidations stand at $190.40 million, up 7% from yesterday. That is a lot of traders getting wiped out. Imagine a skyscraper made of $100 bills, and then imagine it being vaporized. That is the scale of the financial pain we are talking about. The long-short ratio is almost perfectly balanced at 49.64% to 50.36%. It is a statistical dead heat, a market holding its breath. The nearly 50-50 split between long and short liquidations suggests that both bulls and bears are getting chopped up in this range-bound market. Bitcoin alone accounts for $63.55 million in liquidations, Ethereum another $60.84 million, and Solana $8.61 million. The Bitcoin open interest sits at $43.89 billion, while Ethereum's is at $23.63 billion. The CME Bitcoin open interest is at $8.07 billion, up 0.76%, showing that institutional players are still engaged. The funding rates on Binance are at 0.0038%, on Bybit at 0.0043%, and on OKX at 0.0067%, all near neutral. This tells us that the leverage has been flushed out of the system, which is actually a good thing, as it reduces the risk of another massive liquidation cascade. Meanwhile, the long-short ratios on the major exchanges tell a different story. Binance top traders are positioned 1.41 to 1 long, OKX accounts are 2.36 to 1 long, and Binance retail accounts are 2.27 to 1 long. The smart money is cautious, but the crowd is still leaning bullish. That divergence is worth noting. And speaking of holding your breath, the Fear and Greed Index is currently at a bone-chilling 9, which is in the extreme fear category. Let me repeat that, 9 out of 100. Yesterday it was 11, and the day before it was 13. We are in a free fall of sentiment. This is a composite of 7 different indicators, including volatility, market momentum, social media sentiment, and Bitcoin dominance. A score this low signifies that the market is pricing in the absolute worst-case scenario. It is the kind of reading you see at major market bottoms. As the legendary Warren Buffett once said, be fearful when others are greedy, and greedy when others are fearful. MatrixPort's own analysis suggests that this extreme fear reading points to an incoming inflection point. However, it is not a timing tool. A market can stay in a state of extreme fear for a long time. But it does tell us that the elastic band is being stretched. The potential for a violent move to the upside is building. The question is whether we will see a catalyst to spark that move, or if the band will snap under the pressure. The Altcoin Season Index sits at 45, which is neutral, meaning we are not in an altcoin season and not in a Bitcoin season either. The average RSI across the market is 46.88, also neutral. Everything is coiled, waiting for a trigger. To answer the question of where we go from here, we need to look beyond the charts and into the real world. The crypto market does not exist in a vacuum. It is a ship on the vast ocean of the global economy. And right now, that ocean is stormy. The World Uncertainty Index has surged to an all-time high of 106,862, higher than during the COVID pandemic, the 2008 financial crisis, and 9/11 combined. We are seeing trade wars escalating, tariffs being used as geopolitical weapons, and a general sense of unease in the traditional markets. Companies are ramping up currency hedging at an unprecedented pace. The US dollar index stands at 97.36, up 0.31%, and gold futures are at $4,997, up 2.46%. When gold is rallying and the dollar is strengthening simultaneously, it tells you that the world is seeking safety in every form it can find. Even in the crypto space, gold-backed tokens like Tether Gold at $4,975 and Pax Gold at $4,998 are among the top performers, both up over 2% in 24 hours, while everything else bleeds red. All eyes are on the Federal Reserve. The minutes from their January meeting are being released today, February 18th, and the market is on tenterhooks. The consensus is that they will hold interest rates at 3.50% to 3.75% in March, with CME Fed Watch showing a 92% probability of a hold. But it is the Fed's tone that will really move the needle. A hawkish tone could send risk assets like crypto tumbling, while a dovish hint could be the fuel for the next rally. The US 10-year Treasury yield is at 4.02%, nearing its 200-day moving average for the first time since March 2022, which is a significant macro signal. And let us not forget the December PCE inflation report coming on February 20th. It is the Fed's preferred inflation gauge, expected at plus 0.3% month over month, with CPI still at 2.4% above the Fed's 2% target. A hot PCE number could pour cold water on any hopes of an early rate cut. The Fed is the 800-pound gorilla in the room. Their dual mandate is to maintain price stability and maximize employment. The crypto market, like all risk assets, is addicted to cheap money. The era of quantitative easing was the jet fuel for the last bull run. The current era of quantitative tightening is a powerful headwind. Now, there are several other global events on the horizon that every crypto trader needs to have on their radar. In the US, the Clarity Act, which aims to define the regulatory roles of the SEC and CFTC over digital assets, has a White House compromise deadline of March 1st. Regulatory clarity is the holy grail for institutional investors, and a positive outcome here could be a genuine game changer. The White House has also hosted a second crypto meeting focused on stablecoin yield and tokenization, signaling continued engagement at the highest levels of government. The UK is set to allow crypto exchange-traded products in tax-advantaged ISA and SIPP accounts starting April 6th, which could open a significant new channel for institutional and pension capital. And the full enforcement of the EU's markets in crypto assets regulation, known as MiCA, arrives on July 1st. This will create a harmonized regulatory framework for 27 countries, and major exchanges like Binance are already scrambling to get licensed. This is a double-edged sword. It will legitimize crypto for traditional finance, but it could also force non-compliant projects to exit the market, causing some short-term pain. Two major pieces of crypto legislation are expected to drop in Q2 2026, which could provide a much-needed boost to anxious crypto investors. We cannot talk about the current market without acknowledging the ghost of crashes past. The 1010 crash of October 10th, 2025 is still fresh in everyone's minds. We saw $19 billion in leverage positions wiped out in a matter of hours. Bitcoin plummeted from $122,000 to $105,000, and over 1.6 million traders were liquidated. The total crypto market cap lost over $2 trillion. It was a brutal, painful lesson in the dangers of over-leverage, and it has reshaped the market in profound ways. Since then, Bitcoin has continued to slide, now sitting at roughly $67,000, down approximately 47% from its all-time high near $126,000. The US spot Bitcoin ETFs, while still holding about $85 billion in assets, have seen roughly $8.5 billion in outflows since the peak. Just yesterday, February 17th, we saw another 1,520 BTC in net outflows from the ETFs, with BlackRock's IBIT alone losing 1,740 BTC. Bloomberg put it bluntly, Bitcoin won over Wall Street and now it is paying the price. However, European crypto ETF flows have remained positive, suggesting that not everyone is running for the exits. The total Bitcoin held by ETFs since inception stands at a net positive 682,830 Bitcoin, which means the structural demand from these products is still significant, even if the marginal flows have turned negative. So, with all that in mind, let us get to the charts. For our short-term traders, the 4-hour chart is your battleground. We are seeing a tight consolidation range between $65,100 and $72,000 that has held since February 6th. The average RSI across the market is at 46.88, which is neutral. So we are not seeing a strong directional bias at the moment. A potential trigger for a long trade would be a 4-hour candle close above $72,500 with increasing volume. Your stop loss would go below $71,000 with a target of $75,000. A trigger for a short trade would be a 4-hour close below $64,500 with a stop loss above $66,000 and a target of $60,500. The key here is patience. Do not force trades in a range-bound market. Let the market come to you. Watch the CoinGlass liquidation heat maps to see where the clusters of stop losses are sitting, because the market has a nasty habit of hunting those levels before reversing. For our mid-term traders, the daily chart is where the story unfolds. We are currently trading well below the 200-day moving average, which sits at approximately $94,000. That is a significant bearish signal. The Elliott wave count suggests that we have completed a 5-wave impulse move to the upside and are now in an ABC corrective pattern. A senior executive at Deribit has stated that the long-term rally is broken until Bitcoin reclaims $85,000. The key levels to watch are the support at $60,000 and the resistance at $70,000. A sustained daily close below $60,000 could open the door to a move down to the 200-week moving average at around $58,000. A daily close above $70,000, on the other hand, would be the first meaningful sign of a trend reversal. The options market is also telling an interesting story. Options open interest has surged by 139% to $43.72 billion, which suggests that traders are increasingly using options to hedge their positions rather than making naked directional bets with futures. This is a sign of a more mature, sophisticated market. The Bitcoin exchange balance has also increased by 1,980 Bitcoin to 2.48 million Bitcoin, which could indicate that some holders are moving coins to exchanges in preparation to sell, or it could simply reflect exchange wallet consolidation. Either way, it is a metric worth monitoring closely. For our long-term investors, the weekly chart provides the big picture. The long-term uptrend is still intact, but it is being severely tested. The 200-week moving average at $58,000 is the line in the sand. Bitcoin has found support near this level, and as long as we hold above it, the secular bull market thesis remains alive. A weekly close below $58,000 would be a major red flag and could signal a deeper correction toward the $50,000 psychological level. However, if we can hold this level and start to reclaim some of the lost ground, the long-term outlook remains constructive. Tom Lee of Fundstrat is calling for Bitcoin to reach $200,000 by the end of 2026. The Motley Fool has published a prediction of $150,000. Analysts are noting that a shift in the global world order, with the fraying of traditional alliances and a renewed bid for gold, may actually be the early setup for the next crypto cycle. These predictions may seem outlandish given the current environment, but in the world of crypto, the impossible has a funny way of becoming the inevitable. Now, let us talk strategy, because analysis without a plan is just entertainment. For our short-term traders, it is all about range trading and discipline. Buy the support at $65,100. Sell the resistance at $72,000 and keep your stops tight. Risk no more than 1% to 2% of your portfolio on any single trade. Use the 4-hour time frame for entries and exits. Watch the liquidation heat maps on CoinGlass to identify where the clusters of stop losses are sitting, because the market has a nasty habit of hunting those levels before reversing. And here is a pro tip that most people will not tell you. When the fear and greed index is at 9, the contrarian play is to start scaling into long positions. Not all at once, but gradually. History shows that extreme fear readings have consistently preceded significant rallies. Set alerts at $72,500 and $64,500, so you are ready when the breakout happens. For our midterm traders, it is a waiting game. Wait for a clear break of the range before you commit to a position. A confirmed break above $70,000 on the daily chart with strong volume would be your signal to go long, with a target of $85,000 and a stop below $65,000. A confirmed break below $60,000 would be your signal to go short or to step aside entirely. In the meantime, consider using option strategies like selling puts at the $58,000 strike to generate income while you wait. The elevated options open interest tells us that the smart money is already doing this. Also, keep a close eye on the PCE data on February 20th and the Clarity Act deadline on March 1st. These are the catalysts that could break this market out of its current range. The March 18th Fed decision is the most immediate macro catalyst, with its influence on global liquidity likely to override other events in the short term. For our long-term investors, this is where patience and conviction meet opportunity. If you believe in the long-term potential of Bitcoin and the broader crypto ecosystem, then the current market is offering you a rare gift, the chance to accumulate a world-changing asset at a significant discount from its all-time high. The strategy here is simple but powerful. Dollar cost averaging. Buy a fixed dollar amount of Bitcoin every week or every month, regardless of the price. This takes the emotion out of investing and allows you to build a position over time at an attractive average price. Consider allocating to a diversified portfolio that includes Bitcoin, Ethereum, and a small allocation to high-conviction altcoins. And remember the regulatory developments coming in the next few months, from the Clarity Act to MiCA to UK crypto ETPs, are all building the infrastructure for the next wave of institutional adoption. The fact that ETFs still hold 682,830 BTC net, and that European investors are still buying, tells you that the smart institutional money has not abandoned ship. They are repositioning, not retreating. In conclusion, the crypto market is at a crossroads. We have a confluence of bearish and bullish factors, and the next few weeks will be crucial in determining the direction of the market for the rest of the year. The fear and greed index at 9 tells us that the crowd is terrified. The funding rates near neutral tell us that the leverage has been flushed. The options market tells us that the smart money is hedging, not panicking. And the regulatory pipeline tells us that the institutional infrastructure is being built. The short term is uncertain, the midterm requires patience, and the long term remains fundamentally bullish. Trade smart, stay informed, manage your risk, and never invest more than you can afford to lose. That is all the time we have for today. I hope you found this deep dive helpful. If you did, please smash that like button, subscribe to the channel, and ring that notification bell so you do not miss our next episode. We have a lot more in store for you. And as always, I want to hear from you. What are your thoughts on the market? What are your trading strategies? Let me know in the comments below. Until next time, this is Boni, signing off.